Hello there, everyone, and thank you so much for joining us today. I'm Sam, and I moderate these presentations. And in just a second, we'll be joined by Wesley Boudreau, one of our financial advisors. Wesley is going to be covering a great checklist we have for you regarding your taxes for 2025. He'll also go over just a couple questions. I apologize in advance. He will not have time today to answer all the questions, but he'll answer just a couple. And what he cannot answer live, I'll make sure one of our financial advisors can answer with you either through phone or email after the presentation has ended. Before he comes on, I would like to just quickly remind you, we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along. And lastly, while Wesley's speaking to you, you will see some links popping up above his head there. And you can click directly on those links. They'll guide you to various resources, one of which will simply be a link to follow us on YouTube, follow us on LinkedIn. We post tons of retirement-related content weekly, and we really think you get some value out of it if you considered giving us a follow. You can also book a free complimentary 15-minute appointment with one of our advisors to speak to them directly or get started or updated on your retirement planning. And with all of that out of the way, let's kick it over to Wesley Boudreau.
All right. Thank you very much for that introduction, Samantha. And like she said today, we're going to be talking about taxes. We're going to go over some high level items that a lot of people need to be aware of when it comes time for filing taxes and just to be aware of throughout the course of the year and planning accordingly for your taxes and withholding and things of that nature. Obviously, there's a lot to go over. We're not going to go through all of it. We'll talk high level here. We'll cover some different items like deductions and credits. We'll get into that first. We'll talk about investment and saving strategies look at when it comes to saving and taxation. We'll also look at income and taxation strategies. We're not going to get into a lot of detail here, but we've got other webinars and that go more into the retirement distribution phase. But there's some items to be aware of here as well. And then ultimately, really to kind of make sure you have a plan. We'll talk a little bit about what a cash flow analysis from us can provide you and how we kind of utilize that to manage not just the investment strategies, but also the taxes you're looking at. So again, the retirement group, we've been working with employees of Fortune 500 companies for about 30 plus years, helping them transition into retirement. And taxation is definitely something we focus on a lot here as well. As far as getting into the deductions and credits to be aware of, and to kind of go through some, if we do recall, the original Trump tax cuts actually did a couple things. They simplified taxes in some forms for us, which was good or bad for some of you, depending upon what your situation is. But it increased that standard deduction quite a bit, and it's been updated with inflation for the last 7 or 8 years or so. But what it also did was it put a cap or a limit on your property and state and local taxes, those SALT taxes that you hear about. That cap is 10,000 for a married couple, 5,000 for somebody who's single. So if you, let's say, live in California or New York where you've got high income taxes, maybe you are taxed at maybe you spend $15,000 in taxes there, but you're capped at a $10,000 deduction. Could be you're in a higher, even Texas, for instance. There's no income tax, but there's high property taxes. You might have a decent house and you might have $12,000 of property tax. Only 10,000 is going to go towards that. You factor in if you were looking at deducting state and local taxes too, your sales tax, you're going to be capped there in some of these different items. So be aware of that. But again, you'll see in a moment when we go through the standard deduction is pretty high now. Mortgage interest. This is something that had a limit put on as well. The limit was based upon the interest, not the interest, but the size of the loan. So it was limited to $750,000 loans after December 2017, and for those that were prior to December 2017, it was up to $1 million. Medical expenses, something else that hopefully we're not having to worry about, but God forbid we do have some situations where we get into needing some medical care and having high costs associated with that. We can actually deduct if it's over 7.5% of what our adjusted gross income is. So again, something to be aware of if you had to go through a procedure or something like that and had some out-of-pocket expenses. Keep that in mind when you go through and file those taxes and look in that as well. Digging into the tax brackets, kind of where are they now and what do they look like? I'll zoom in here in a moment because even without my glasses, that looks pretty blurry. But you've got your standard tax brackets at 10, 12, 22%, 24%. Then you got 35, 37% on here. If we kind of zoom in here, excuse me, 32, 35, 37. But if you look at some of these, the one I'd kind of draw attention to is we look at maybe the married filing joint in that middle column, or I guess, yeah, middle column, if you would. At that 12%, you see that caps out at $96,950. Then you jump up 10% from that 12% to that 22% tax bracket. Now, right now, the standard deduction for a married couple is actually up to $30,000. So you take that and add that to the 96,000. That means that you're at 12% or less for income that's under $126,000. Once you go above that, let's say you made $130,000, then that extra 4 grand or so is going to be taxed at the 22% tax bracket. So this is important because we deal with a lot of individuals that are retired and they may be living well within their means, and so maybe they're only spending $100,000. That means we've got another $26,000 or so that they could potentially pay taxes on at 12%, which I'd argue is a pretty low tax bracket, and get that converted over to a Roth IRA so they get that growing tax free. So again, a basic strategy to kind of look at and be aware of. But this also comes into play whenever you're looking at what your withholdings are. What type of 401k contributions am I going to do, a pre-tax or a post-tax or a Roth contribution? So we go through all those different items with you while you're still working or while you're retired as well. But definitely that 12%, that 22% is the big jump. There's definitely some tax strategies to look at there. And then the higher you get, obviously, those strategies are still available, but the bang for your buck, if you would, kind of diminishes a little bit. And we also have to be careful about getting into some other tax on top of that, which will be go on one-on-one basis. As far as some different credits, if you're still younger or you're caring for kids or had kids later in life, there's also the child-related credits you have. You got the basic child tax credit up to $2,000 per kid. I've got quite a few kids, so I take advantage of this in some cases. There's also the child independent care. So they cover up, or you can deduct up to 35% of your cost there, up to $3,000 per child. So again, if you're sending them to daycare or something of that nature, or maybe even having paying an in-law or somebody to watch them, that could possibly work as well. And then if you've been having trouble and you're looking at adopting, then there's some favorable tax treatments there as well to help you with those costs, up to about a $16,800 expense credit for adoption expenses there. So again, something to look forward to if you are looking to adopt instead. Also, if you are looking at being more energy efficient, the credits have kind of jumped around over the years. They're not quite as good as they used to be, but they are still there. So if you're looking at a solar tax credit, you can get up to 30% of installation costs, whether it be that you're doing just simple solar hot water heaters, or you're doing a full solar house on your roof or something like that. Also, if you're looking at electric vehicle, if you've got one or you got your eye on one, there's still some potential tax deductions there, anywhere from 4,000 to 7,500, depending upon what your income limits are, what the different cost of the car is, and things of that nature. Obviously, if you're going in shopping, they're going to tell you the details about these tax credits because it's definitely a selling point to them where it overall can reduce the cost when you're comparing a battery powered vehicle versus gas powered vehicle. So again, keep those in mind if you've done that this year. As far as retirement contributions, so for those of you that are still working and having earned income and you're making contributions to your accounts, whether it be the 401k or an IRA, if you're making them on a pre-tax basis, that's where you get to take that deduction. So, for example, let's say somebody makes $100,000 a year and they contribute 10% to their 401k on a pre-tax basis. What would happen is that $10,000 goes in there and it comes off your adjusted gross income. So, as far as your IRS is concerned, you only made $90,000. So, you're saving on that $10,000. You're not paying taxes on it. But eventually, once that grows over time, when you take that in the earnings out, you're paying tax at whatever your tax bracket is there. The expectation was always to have lower tax brackets in retirement. So again, that may or may not be the case. We never know because tax brackets can change. Maybe you've done a really good job and you've built up a bigger nest egg than you thought. You might have higher income in retirement. So again, things to be aware of and look at there. If you're doing post contributions after tax or Roth, you're not going to get that deduction. For an IRA, you also can still potentially, based upon income limits, make contributions there. Oh, I'm sorry. So going back to the 401k, the limits have been bumped up again. 23,500 is the max for pre-tax and Roth contributions to a 401k. If you're over 50, there's an additional $7,500 there, so you can get a full $31,000 in there if you can afford that. And then for the IRA, you're looking at $7,000, and if you're over 50, $1,000 catch-up, so up to $8,000, again, based upon income limits, you can potentially put in there as well and get that tax deduction on that side as well. Now, as far as Health savings accounts is another vehicle that, like a 401k, where you're able to save pre-tax, but it's going to be not for retirement. It's going to be built in for healthcare costs. So whether you're using that for out-of-pocket expenses or co-pays, or you let that build and grow, and once you retire, using it for additional medical costs, those are going to be excuse me, pre-tax and tax-free distributions if you're using them for qualified expenses. And depending upon if you're single or a family, that's going to be $4,300 if you're under 50, plus another 1,000 over 50, or 8550 if you're a family. So again, over 50, then you're looking at that 9550 that you could put in there per year on that pre-tax basis. Let that go towards either current medical expenses, or again, let it defer and build and go to future medical expenses as well. Now, as far as, let's kind of transition into, okay, I'm actually taking money out. Maybe now I'm retired and I'm trying to figure out, how are these taxes going to affect me whenever I start taking Social Security? So we've all been putting money in, or excuse me, paying into Social Security based upon FICA taxes while we were working. Now you're not going to have FICA tax anymore because you don't have earned income if you're taking withdrawals, and you're living off of Social Security and maybe withdrawals from your 401k. What's going to happen is you are going to potentially have to pay taxes on that Social Security. That's all going to depend upon how much income you have, including Social Security, on a single or a married basis. And there's different levels of, either you could get away with no taxes whatsoever on Social Security, or 50% of that Social Security could be taxed and count towards your income, or 85% of it can count towards your income. Again, glasses aside, let me zoom in here so you guys can see this a little bit better. So somebody who's single, if you're making under $25,000, no taxes on it. 25 to 34, it's going to be 50% of it's taxed. Over 34,000, 85% of your Social Security is taxed. For a couple under 32, it's tax free. 32 to 44, it's 50% of it's taxable. And then over 44, you're looking at 85% of it taxable. So let's say that you've got a couple that, go back to that situation I said before. Maybe they're taking out, or spending $100,000 a year. That's obviously over $44,000. So what's going to happen is, maybe 30 grand of that's their Social Security. So only 85% of that $30,000 is going to be taxable, or count towards their tax calculations when it comes time to file. And you also got to figure out that in some cases states are different where they tax this or maybe don't tax it as well. So we go through all that when we run a plan, if you're thinking about retiring in different state than what you're currently living in. As far as pension income taxes, now this can be viewed just like you take withdrawal from an IRA or a 401k. This is really going to be pre-tax money, so it's going to be taxed eventually. Now, if you're taking a pension lump sum, there's some things to kind of be aware of that. If you take that lump sum directly to yourself, which we rarely see, unless it's a small old plan that somebody's taking, or maybe somebody made a mistake before calling us. That's going to be taxed when you take that out, and that's going to be at your ordinary income. And if you happen to be under 59 and a half, it could potentially have an additional 10% penalty on there as well. Now, if you take that pension lump sum and roll it over to an IRA, which is what we tend to see 99 times out of 100, maybe 999 times out of 1,000, you're going to actually defer those taxes. You're going from like to like, an ERISA tax deferred plan over to another qualified tax deferred plan. So you're no paying tax till you physically take that money out to yourself. And at that point, it's going to depend upon your age and some other options, whether you're paying just taxes or a 10% penalty as well. So as far as the traditional IRA and the 401k, when you take those withdrawals out of there, the withdrawals from both those, assuming it's coming from your pre-tax money and not any after-tax or wealth portions, you're paying taxes on that at your ordinary income tax bracket. So again, like I said before, we tend to save in our 401ks because we think we're in a higher tax bracket now than what we're going to be in retirement. So fast forward and you're retired and you're taking withdrawals, hopefully you're at a lower tax bracket than your expectations were. Obviously, I think we said before in that example, 12% I would argue is pretty favorable. So you want to max that out if you can. If you're above that, 22 is still not bad compared to historical tax brackets. But if we fast forward 10, 15, 20 years, there's no telling where tax brackets could be. So it's important to kind of manage this early on in retirement as well, and focus on Roth conversions and things like that. Now, again, like I said, if you're under 59 and a half, it could also have a 10% penalty on there. There are some different exceptions, like first-time home purchases, medical issues, secondary education, things like that. But the two big ones that we tend to see are the age 55 rule and 72T, which is substantial and equal periodic payments. These are two rules under the IRS 72T code. But what's going to happen is I'll tell you, first, like I said, we work with a lot of individuals from Fortune 500 companies, help them retire. One of the biggest things I'll tell you to put your kind of radar out there is that, let's say if you're 56, 57, 58, and you're retiring from a firm and you got an advisor telling you, hey, roll everything over to an IRA, we can help you manage it, they're likely possibly thinking about themselves and not you. So what happens with age 55 is if you retire from the company that you work for at age 55 or later, or really just the year you turn 55. So you could literally retire in January as long as you turn 55 by December. Um, and what happens is you can take withdrawals from that 401k based upon the plan restrictions, how often they let you withdraw, and things like that. You can take withdrawals without that 10% penalty. Versus if you had talked to that advisor, rolled over to an IRA, and you take a withdrawal, you're going to pay a 10% penalty unless you set up a 72T, which we'll talk about in just a moment. So we tend to like people keeping money in that 401k, even if we think it's better for us to manage it. But if they're taking withdrawals, we think it's easier and more flexible for taxes to avoid that 10% penalty in there. So again, give us a call. We can dig into this for you in detail. Now, if you do happen to have it in the IRA already, or you retired at 53 and you can't take advantage of age 55, 72T allows you to stretch out your payments and agree to a payment structure to yourself based upon IRS codes and IRS interest rates. And good news is they used to be low, but they bumped these rates with interest rates coming up, so you don't have to. It doesn't take as much of an account to get a higher dollar amount. But what happens is you have to agree to take out the same exact amount for the next 5 years or until you turn 59 and a half, whichever's longer. So if you're 57, you're gonna have to do that for 5 more years. If you're 53, you'll have to do it for 6.5 years. And again, that's not something that we dictate. Again, it's based upon what the IRS code set. And if you make any mistakes on there, they can come back and retroactively penalize you. So again, be very careful about this. We can go into all the ins and outs on that and pros and cons with you as well, because we've done it extensively. But you want to make sure you work with a firm that has that expertise, because if you do make a mistake, it can come back to haunt you quite a bit. Now, as far as managing taxable accounts, this is money that is not your 401k or IRA. Maybe it's a stock brokerage account that you've saved in. Maybe it's even just a bank account that you've got after tax savings in. What's going to happen is the interest from that's going to be treated as ordinary income because you're getting that interest posted within a year, so it's taxable. So again, CDs, money markets, things like that. If you've got investments in stocks, bonds, mutual funds, typically what's going to happen is they could kick off dividends and/or capital gains. And if those capital gains are realized within 1 year time frame, that's called a short-term capital gain, and it's going to be taxed at ordinary income brackets. If it's long-term capital gains been held for over a year, it's going to be taxed as long-term capital gains, which could be either 0%, 15%, or 20%, depending upon your tax bracket. But if we go back to that tax bracket page, it's all going to add up where those are going to be lower than your ordinary income tax bracket. So that's the benefit there of holding that. Depending upon your actual tax bracket, that delta, if you were to the difference between those, is a little bit different. But across the board, you're going to have tax savings there. And then taxable accounts, they offer the advantage of also having no required minimum distributions. So just like a Roth IRA, no required minimum distributions at this time. If you save there, or you pull out money and build up some savings, that's going to reduce your potential RMDs in the future at 73 or 75, depending upon your specific age. And like I said before, we get into cash flow planning and go into the retirement distribution phase to really show you how like a Roth conversion over time can help you out. But really between retirement, let's say it's 60, 65, and RMD age of 73 or 75, there's a lot of different planning we can help you out with there. So what about withholding and payments? While you're working, you fill out your forms and you have your standard withholding and take them. And so at the end of the year, you tend to either pay a little bit or get a little bit back in taxes. Usually, you still do the same thing when you're retired. It's not just there's not a simple solution to it. So what's going to happen is you need to kind of estimate or figure out your taxes. We can go through and help you with that as well to determine what your potential withholding would be. So very simply put, let's say if somebody was in the looked like they were going to be that 12% tax bracket. So they'll be in the 12%. It's pretty simple. Withhold 12%, but in reality, there's a 10% and a 12%. So your average tax bracket might be 11% or 11.3 or something like that. So, but if you're withholding that 10 to 12%, you'll probably be in good shape there. You want to make sure you keep those withholdings up to date, so you're not underpaying and run the risk of underpayment penalty. And you also don't want to overpay and give the IRS interest-free loans. You don't want to overpay too much. A lot of people say, "Oh, it's great. I get my tax when I do my tax. I get my refund." That's your money. That's money you gave the IRS interest free. So keep that in mind if it's a large refund you're getting. Um, and then as far as if you're not making consistent distributions, you got other self-employed income or rental properties, things like that. Make sure that you are doing quarterly taxes, so you're keeping up to date with that and not underpaying and and being subjected to potential penalties there as well. So let's kind of go through again. Like I said before, we've covered some topics. There's no way this is nearly everything you need to be aware of when it comes to tax time, but these are some kind of key topics. And I'd go back to the aspect of really that transition from working to retirement. Just let us walk you through that, and we'll kind of go through some of those things to be on the lookout for. It's a lot easier in retirement, unless again you've got multiple properties in different states and things like that. But if you've just retired, roll over to an IRA, and you're working with a retirement group or somebody else managing those, it's not too difficult on the taxes. But there's definitely some strategy to look at for long-term planning there. So that checklist, we talked about deductions, the SALT taxes, property taxes, mortgage interest deductions up to the 750 or $1 million mortgage, the 401k and IRA contributions that you're looking at there, credits, the child tax adoption credit, child dependent care credits, solar tax if you're going solar, electric vehicle taxes. We talked about the savers credit there. I don't think we had that in there. I apologize. And then as far as things that are taxed, we talked about the tax on Social Security again. 0%, 50% of it, or 85% of it's going to be taxed. Again, that's not the tax rate; it's what portion of it is taxed. How your pension could be taxed. Again, if you're taking that pension as an annuity and it's coming out to you, that's always going to be taxed to you at ordinary income. If you roll it over to an IRA, there's no tax till you physically take that out. But if you were to take the pension as a lump sum, it's taxed at that year. And then the 401k or an IRA, again, you're paying tax on it as you take it out. Okay. And like I said before, and I've kind of alluded to it, really the best way to really check on this situation is to run a cash flow analysis or a financial plan with us. This is all complimentary. We do this all day long with clients and prospects. But honestly, right now, about 3/4 of Americans over 50 don't even have a written plan. If you can spend about 10 to 15 minutes with us gathering some basic data on your assets and your spending and things of that nature, we can run a detailed financial plan for you, have it ready within about a week probably, and sit down and go through that with you to show you, okay, here's where you stand. Maybe you're saying, hey, Wesley, I want to retire at 60, but I'm not eligible for Social Security until 62. Is that something I can do? We can run through that plan and tell you here's what it would look like, not just now, but how it plays out in 20, 30, 40 years. Here's what would happen if you worked a couple more years till 62. Here's what would happen if you deferred Social Security to full retirement age. We can go through all those different scenarios with you. So just reach out and let us know. We'll be happy to go through that with you. So I know we didn't jump into the beginning, but just a quick refresher, if you haven't been on one of our webinars, who the Retirement Group is. Again, we are an investment advisory firm that specializes in working with corporate employees, helping them transition into retirement. We've been doing this for about 30 years with various Fortune 500 companies. And we also we're part of Wealth Enhancement Group, which is a large registered investment advisory firm. Got a little bit over $100 billion under management, about 100 plus offices throughout the United States. So rest assured, if you need to sit down with one of us, we can likely accommodate you there. But a lot of our advisors on the corporate side or on the corporation side tend to focus on anywhere from 3 to 10 different companies. So that way you've got a deep understanding of your specific company plans inside and out. So if you have questions on your 401k, excuse me, if you have questions on your 401k, or you've got, I sincerely apologize about that. You've got questions on your 401k, or you've got questions on your pension plan, or you've got questions on life insurance continuation, or your medical plans, things of that nature. We can dig into all of that information for you. So just reach out, let us know, and we'll be happy to help you on that. And like I said before, that complimentary cash flow analysis, take us up on that. If you haven't done one in the last year or two, and we've done one before, reach back out to us. Obviously, some things have changed as far as interest rates and the markets as well there. So and with that, I'm going to kind of wrap this up. I do think we had two questions come through that I'll knock out. If we have any more, we'll try and get back to you on those. But if you do have any questions for us, you can use these QR codes I'll leave on the screen to get into both our LinkedIn page and to schedule an appointment with myself or one of the other advisors. The LinkedIn page will let you get some more specific company information if you want to follow along with your company details, updates on new webinars, going over different items, things of that nature as well. You can reach us at info@theretirementgroup.com, and you can always call us at 800 900 5867. Okay, so the first question I have coming here is it better to take withdrawals from my 401k or take them from an IRA? Okay, this is actually it's a pretty good question. It's one that we talk about all the time, especially under fiduciary rules and transitioning an account from a 401k to an IRA. I'd say 9+ times out of 10 when somebody retires, they tend to roll over their 401k to an IRA because there's a lot more flexibility as far as investment choices, but also on the taxation. It's not going to change the taxes for you unless, again, let's say that individual that asked that question is 57, then I'm probably going to tell them, no, you don't want to roll it over to an IRA just yet because we can take withdrawals from your 401k if you need them um, on that post 55 rule. So with a no 10% penalty, whereas if we moved it to an IRA, we could still avoid the 10% penalty, but we have to do that 72T I talked about and set up for 5 years. So it's a little bit more complicated. But generally speaking, like I said, a lot of times people roll over to an IRA because there are a lot more investment choices. But as far as the taxes in a 401k, most of the time, if you take withdrawal, there's an automatic withholding of 20%, which is good for a lot of people because it helps them withhold, especially if you're in that 22% tax bracket. But like I said, a lot of people might be in that lower 12% bracket. So let's say that you take out 50 grand in a year and they're withholding 20%, so $10,000, but you're only in that 12% tax bracket, and that's a good chunk of money that's going to the IRS interest free that you have to wait until you file your taxes to get back. So I'd argue get that over to an IRA and actually withhold the 12% in line with what your actual tax bracket is. So that's one thing to think about in that aspect. But again, it's going to be a case by case situation. Generally speaking, the IRA is going to be more flexible than what the 401k is. But again, there are some pros and cons to look into with that. Um, Another question here: if I do a Roth conversion, how does that affect my taxes? Okay, I actually I mentioned some Roth conversion strategies, or kind of touched on them a little bit. That is definitely something to be aware of, and a lot of times we've seen people make mistakes and not thinking about that. Let's assume that I'll have to give an example. So let's assume that I think I said before somebody may be making $100,000 a joint couple. They're in that 12% tax bracket. They've got another 26 grand or so they could go before they get to that 22. So in their case, it's kind of simple. It might be, well, let's just take out 25,000 a year and convert that over to a Roth IRA. We'll pay that 12% tax bracket. So not that big a deal. It's going to be kind of in line with what their withholdings probably already were. But let's say that you want to do a larger Roth conversion and you said, hey, I'm going to max out the 20, not the 22, but the 24% bracket before I jump up into 32. Maybe you took out 100 or $200,000 and converted that to a Roth IRA. So now what's happening is the question is, are you converting that and then paying the tax out of pocket, or are you taking the taxes out in that conversion? And all that kind of dictates what that break-even analysis is going to be as far as how long it takes to recoup those taxes. Because yes, that's a great thing to convert, let's say $200,000, because what's going to happen is that's going to get out of your required RMD in the future, and that's going to start growing tax-free for yourself and your beneficiaries. But in that case, instead of being maybe in that 12% tax bracket, now you're in that 24% with a good chunk of that and 22% with a good chunk of it. So again, you want to make sure that you are withholding appropriately, or you have outside assets in order to take care of that. So hopefully that kind of gives a little bit of it. Another thing to be aware of too is depending on your age. We've seen this a lot. People make mistakes and they don't review it with us prior is you could jump up and be affected by IRMA taxes, which is for Medicare taxes. If you've got a higher threshold, you're going to pay a higher premium on some of your Medicare deduct your Medicare payments. So be very careful about that as well. So that's another aspect to think about in larger Roth conversions. Just give me a call. We can kind of go through these on a one-on-one basis and give you a full breakdown of what your break-even analysis is and how everything can kind of play out there as well. So again, I want to thank everybody for taking some time with us today. We hope you have a great rest of the day. And if you have any questions, just simply call us at 800 900 5867. Thank you and have a great day.